Hi friends, welcome to Dhiksoochi. In this video, we are going to learn cost of capital with Dr. Sabitha Godasu. In the previous video, we have discussed capital structure. We know that how the funds will be raised by a firm to start its operations. So what are those? What are the sources of raising the funds? Those were, just for recapping them, one is debt, the other one is share capital. Again in share capital, there is a preference share capital and the equity share capital. Right? Now, we are going to study in this video what is the cost of raising these capital. What is the cost of raising the capital? Is what the cost of capital, right? So it is denoted by K naught. Denoted by K naught. Okay. Now let us see how this K naught will be calculated. Right. So first come to this debt. Once your funds are raised through debt, you are going to pay the interest. Right. Interest. Then this will be denoted as KD. Cost of debt is denoted as KD. What is KD here? KD is equal to interest into 1 minus T. Why 1 minus T? If you recollect the previous videos where we have discussed the valuation concepts, there we discussed value of the firm, financial leverage and operational leverage. When you are talking about financial leverage, there we get to know that. So how you calculate there? EBIT minus interest. Then you are going to deduct the tax. It means that whatever the interest you are paying, it is not taxable. Okay, because of which this amount is avoiding paying certain amount towards the tax. That is what we are considering as cost of debt as I into 1 minus T. So cost of debt is equal to I into 1 minus T. This is one. Then preference share capital. So this will be denoted by KP. Generally preference share capitals are not issued in India and most of the problems are not taken into consideration. So anyhow, the preference share capital, how it will be calculated will be known. If you know, then that helps us in future if required. Okay. So cost of preference share capital, it is denoted by KP and it is calculated by the amount paid in terms of the preference dividend divided by the preference share capital. Whatever the amount paid in terms of the preference dividend. So in the previous video we discussed, if at all you are raising 1 lakh of rupees through preference share capital, let us assume this is raised at 8%. Then what is the amount you are paying? 8% means 8,000 you are paying. Right? So 8,000 you are paying in the sense 8,000 divided by 1 lakh. That is what 8% is. So that is cost of preference share capital. Now equity share capital. Once the equity share capital is raised from the public, then the profits whatever the firm gets at the end of its financial year, the profits will be equally distributed. Profits will be equally distributed at the end of every financial year. And there is a small clarity over here which further discussed in further videos. That is, whole profit is not paid in terms of the equity shareholders dividend. That generally we name it as earnings per share. The profit, out of the profit, whatever the share on each preference equity share capital gets is earnings per share. So this earnings per share, let us assume it is 1 rupee. But this whole 1 rupee is not paid to the equity shareholder. They may pay only 60 paisa as dividend. Remaining 40 paisa will be retained earnings. Okay. Retained earnings means this 40 paisa will be kept with the company for further growth or expansion or anything, whatever the operations they wanted to do it. Of course, this is the amount of shareholder only. But this will be retained with the company. retained with the firm, right? So now the dividend paid to the equity shareholders is 60 paisa. So how the cost of equity will be calculated? Let us assume cost of equity is denoted by KE. This generally there are many ways to calculate it. But when come for this cost of equity, generally we use one small formula, that is, first we consider risk-free return. The RF means risk-free return plus beta into RM minus RF. So what is RF? Risk-free return. What is beta? Beta is a systematic risk, which was already discussed in the previous videos when the video was types of risks. Okay, there we discuss systematic and unsystematic risk. So beta is systematic risk. Then what is this RM? Market return. What is the return you are getting in the market? And risk-free return. So this also can be said sometimes as a capital asset pricing model. That formula, expected return, also will be calculated by using the same formula. So here the cost of equity is RF into beta into RM minus RF. So this is generally we use it, right? Okay. Now we got the cost of debt by applying the formula of I into 1 minus T, that is cost of debt. We know cost of preference share capital. We know the cost of equity. Okay, these are the three forms how you need to pay in return once you raise the funds through these sources. Now there is also another cost what you need to consider, that is retained earning. For example, in the year 2019 your retained earning is 2 lakhs. Clear? And in the year 2020 the 2 lakhs will be taken into consideration, and this year retained earning, let us assume it is 1 lakh, and this year you paid the dividend of 1,50,000. So your retained earnings will be 1,50,000. This is how you can use this fund for the further operation. So even when you talk about the capital structure, if at all for the existing company, the three sources whatever you are discussing, that is debt and preference share capital and equity share capital, along with that you also have to add retained earnings. Okay, so there we use the retained earnings. Now we have to calculate the cost of capital. So cost of debt. Cost of capital. When you want to calculate cost of capital, even sometimes it will be denoted with KC. Okay, so this is weight of debt into cost of debt plus weight of preference share capital into cost of preference share capital plus weight of equity share capital into cost of equity share capital. So you know how to calculate the weights, which was discussed in the previous video. Now you know how to calculate the weights of debt and weights of debt and equity share capital and preference share capital in this video. So adding up all these is going to give you cost of capital. Clear? So let me summarize. The cost of capital can be calculated by adding up all the sources of funds raised through debt, preference share capital and equity share capital. So how you are going to add up all these things? The respective weights into respective costs will be taken together and summed up will be given you, is going to give you cost of capital. I hope all understood how you calculate the cost of capital. This is all for this video, and remaining will be discussed in the further videos. Till then, bye bye, take care.